Hello fellow traders. Today we're going to get into the introduction of the cup and handle pattern by Pajama Trader. Understanding the cup and handle pattern helps traders anticipate possible breakout pattern scenarios. It acts as a visual representation of market psychology, showing a phase where the stock consolidates profits, shakes out weaker hands during the handle phase, and then resumes upward momentum. Exxon's chart shows this in an excellent detail, and it also shows this pattern come out in real-time market conditions. So give this a like and subscribe, and let's get into it. The anatomy of the cup and handle pattern illustrated on Exxon. The structural components of a cup and handle pattern is clearly observable in Exxon's trading range around September 26. The cup is shown by a gradual round price decline down to 115.90, a solid support level tested multiple times, followed by a measured recovery rally that approaches resistance around 118.35. This forms a smooth U-shaped bottom without sharp V-shaped spikes indicating balanced supply and demand forces. The subsequent handle forms as a minor pullback and consolidation occurring around 117.22 price range, characterized by sideways or slightly downward drift on volume, preparing the market for a potential breakout above resistance. The rounded bottom of the cup signals a shift in market sentiment from bearish to bullish as selling pressure eases and buyers gradually enter. The handle provides a short-term pause, typically shaking out less confident traders while volume diminishes, a volume sign that the upward trend can continue. XOM, the price action during this period, exemplifies the textbook formation of this pattern, demonstrating stable support and measured consolidation. A better look at the cup and handle. So I wanted to go over a cup and handle. So looking at this chart here of ExxonMobil, looks like we got the handle forming here, and you could even say there's a handle here, and this seems to be the body right around this area here, and this would be, I guess, the rim of the cup. And then you have confirmation of a breakout beyond that. So how do you play it? Well, you see the run up here and along with the volume, and you could pretty much just set support at 112, play this run up, and if the pullback looks like it's not going to hold, you could sell half of it and then let the rest of it run throughout this formation, taking profits at 118 and more. Technical characteristics of volume patterns in ExxonMobil. A characteristic of robust cup and handle patterns is a cup depth that's usually less than 50% retracement of the prior price advance, preserving the bullish integrity. Exxon's cup depth adhered to this benchmark, sustaining a bullish structure. Volume analysis plays a crucial role. Typically, volume during the cup formation declines as selling pressure abates. Volume during the handle remains subdued, and significant increase in volume accompanies the breakout above the handle resistance, signaling strong buyer commitment. On September 26, Exxon's volume presented this classic pattern, with volume waning during the cup and handle phases, and spikes noted as prices approached resistance at 118.35. Volume trends are the heartbeat of technical signals. In Exxon's case, the drop in volume throughout the cup and handle phases indicates sellers stepping back in, allowing buyers to accumulate shares very quietly. The uptick in volume on the breakout day confirms demand is overpowering supply, a crucial factor for sustained price moves. The analysis reaffirms the reliability of the pattern and signaling favorable entry points. Breakout mechanics and trading signals in Exxon's pattern. The critical event confirming the cup and handle pattern is the breakout above the handle's resistance, set near 118.35 for Exxon. On September 26, the price closed just below the level of 117.22, suggesting anticipation for a potential breakout. Traders watch this level closely. A sustained close above it, ideally on high volume, signals the start of a new bullish impulse. Conservative risk management involves placing protective stop loss orders a few percentage points below the handle's lowest boundary, right near 115.90, to guard against any failed breakout reversals. Price targets can easily be estimated by measuring the cup's depth and adding it to the breakout point, a method projecting the possible upside to the 120 or 121 range for Exxon. Efficient trading relies on understanding breakout signals combined by prudent risk controls. Exxon's price action and volume on September 26 show the handle consolidation nearing completion, and the decisive advance above 118.35 would validate the pattern. Traders should be vigilant for volume confirmation and avoid false breakouts, placing stops below the recent handle, the low of it, to eliminate downside risk. Market context and energy sector implications for Exxon. In addition to the pattern, broader market and sector factors reinforce Exxon's bullish case. The energy sector in late September of this year experienced supply concerns and raising commodity prices, both of which provide fundamental tailwinds for Exxon. Relative strength in Exxon compared to its peers support the technical outlook, as the sector momentum often amplifies chart patterns. Understanding how the cup and handle pattern operates within its macro and sector environment enables traders to gauge the sustainability of the breakout and fine-tune trade sizing and timing accordingly. No technical pattern exists in isolation. The synergy between Exxon's price structure and favorable energy sector dynamics increases confidence in the breakout success. Traders benefit from monitoring sector ETFs and commodity price trends along with the technical setup to enhance decision making and manage exposure during the volatile periods. Practical trading strategy based on Exxon's cup and handle pattern. Recognizing the strategic execution, traders can plan entries at or just above 118.35, using the expected breakout as confirmation. Adequate risk managed through clear stop placement near 115.90. Profit targets are derived by measuring the cup's depth, 240, added to the breakout level, estimating a potential move above 120. This approach balances reward potential with risk constraints, leveraging both technical and volume signals reflected in Exxon's 2026 chart. This actionable takeaway from Exxon's example is discipline and in its approach to trading the cup and handle pattern. Setting entry stops and target allows for a trade aligned with technical evidence and market context. This helps preserve capital while participating in probable upside moves. Summary and next steps. The cup and handle pattern remains one of the most reliable, insightful chart formations in technical analysis, offering traders a window into potential trend continuations with defined entry, stop, and target areas. ExxonMobil's price action on 2026 this year, 2025, provides a compelling real-world example of this pattern unfolding, highlighting the interplay of support, resistance, volume dynamics, and breakout potential within an active market environment. Understanding and applying this pattern not only improves timing and risk management, but also equips traders to make informed decisions aligned with broader sector trends and market conditions. As the next steps, traders should closely monitor breakout confirmation above key resistance level, affirm volume support, and maintain disciplined risk controls using stop losses or trading with lesser amounts, and identify the levels in the cup and handle areas. Integrating technical patterns like the cup and handle with formation context enhances the probability of success in dynamic markets like energy. By continuously refining the pattern recognition and trade management skills, traders can capitalize on the opportunities presented by patterns such as this and navigate market cycles with greater confidence. Thanks again for watching.